If you're worried about a stock market crash, this video is for you. Today we're going to dig into 5 of the biggest market corrections in the last 100 years. What happened and why? Hi, I'm Dave Lopez.
And I'm Chase Lopez, and we're investment advisor representatives with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement. Now, Dave, before we get started, just want to let everyone know, go ahead and hit the like and subscribe button below. That way you can be alerted to any future videos.
Yep.
So we're going to talk about the 5 biggest stock market crashes. We call them the 5 biggies, right? So let's just jump right in.
Yeah, what's interesting about them, and we want to preface this, is what I want you to notice as you're listening to them, all of them are completely different. Why they happened is different. What happened is a little different. And we're going to be able to use that data moving forward to help decide how to insulate, I think you used that term before, insulate ourselves to minimize damage when the next one comes. Because what you will see from this is a normal part of the stock market is it goes up and it also goes down. So going into the stock market thinking it's not going to correct is unrealistic.
Yep.
That's like going to the ocean and being surprised that we have low tide. It's part of how the stock market performs.
That's a great point. Why are we doing this video about the past 5 stock market crashes is so that you, the audience, can be prepared for it, right? And we're going to talk about some steps you can take to help yourself.
Yeah, that's the most important part.
Right.
So let's jump right into it. Let's start with the biggie of the Great Depression, Chase. Black Tuesday, October 29th, 1929. So just to preface this, the stock market had been rising steadily through the 1920s, reaching an all-time high in September of 1929. And this is kind of funny. A big economist at the time had declared that the stocks had reached a permanently high plateau. So that's economic speak for we're never going down again.
Permanently. That's an interesting way to use that word.
Yeah. And you can guess what happened, right?
Yeah.
He was corrected very quickly after that, right? So right after that, the market started to sell off. And on the big date was October 24th, right? We started to see some selling begin, but it really picked up steam the following Monday. And by Tuesday, which they call Black Tuesday, October 29th, the Dow had fell by about 13%. And I think
I think it went down 12 and 13% in back-to-back days. Basically.
Yeah, 12 and 13% back-to-back days.
Yeah,
Thank you for saying that, right? So the market
incredible.
Continued, but then it cascaded, right? And it continued to go down, down, down. And the market fell over the next few years, and it finally bottomed out, went all the way to July of 1932.
Yeah.
And that's where it finally hits bottom. The Dow closed, get this, at 41.22. That's an 89% market crash. Can you imagine losing 89% of your life savings over roughly 2 to 3 years?
And it took 3 years. I think that's a big takeaway there is it didn't just happen overnight, right? It took 3 years for the stock market to go down 89%. And then finally, after 3 years is when it finally started to recover.
It's finally started to recover. And when it did recover, right, it wasn't until, goodness gracious, I think it was 20 years? 1954, November of 1954 before it finally recovered. So if you were in there in 1929 and it crashed and you had gone with a buy and hold strategy, you would have had to wait 20 years. If you were 60, you would have had to wait 80, never touching your money just to get your money back. Now, part of the reason it happened is back in this era, people had been lured into leveraging the stock market. So imagine if you had $10, instead of putting $10 into the market, they used $10 to borrow another $90, invested $100 in the market of borrowed money. And leveraging works great when the market's going up. It destroys you incredibly fast when the market crashes. So as a result of that, they started to really, it's 100 years later, people are really still soured on leveraging and using margin calls on the stock market. That was one of the main reasons we had trouble with the market, and it also spilled into the rest of the economy.
Yeah, and one of the things that was a result of that whole fiasco, right, is the stock market and all of the different tentacles that it touches. They're a lot more regulated now, right? It was a very unregulated.
It was the Wild West.
It was the Wild West back then. So the silver lining of all of that, right, is we, as mistakes happen, we create solutions for some of those mistakes.
Yeah.
So that was the Great Depression, Black Tuesday, right? The next one that we're going to talk about is Black Monday. That was October 19th of 1987. So Black Monday in the late 80s was a little bit different than what we were talking about with the Black Tuesday in the Great Depression. This Black Monday actually happened very quickly, right? The stock market went down very quickly. On October 19th, the Dow at the time dropped 22.6% in one day. So it was literally cut by a quarter in one trading day. It was kind of an isolated incident, right? There was a lot of different reasons as to why that was happening. We had, geopolitical tensions and things like that, but it really went down and then immediately started to recover after that. A lot of people called it like a flash crash.
Yeah, and it didn't affect the economy.
Right, right.
Other than the market, like
Right.
29 affected the whole economy.
That's a great point.
It triggered the economy and the Great Depression breakdown. That did not happen in 87.
Right.
Just if you had money, you felt it. But if you didn't have money invested, you might have felt like the economy was going along regularly.
And this is a great example. You talked about buy and hold with the 1929. This is a great example of a moment in time where the solution was not to panic, right? Because if you didn't panic and you just held on while that happened, the market recovered fairly quickly. And in 1987, so 2 or 3 months later, the stock market actually ended with a slight gain. So for the year, right? So it went down and then it quickly came up. But this just goes to show every correction is a little bit different, right?
Yeah, so you had one correction we talked to you about that it took 25 years to get even.
Right.
One of them that took 2 to 3 months
Right.
if you hadn't panicked to get even. But
Right.
in either case, you would have had to have held and not panicked.
Right.
The other
Right.
thing about 87 that's very interesting is you had mentioned very briefly flash crash. One of the things that triggered that is, remember, we were just moving into computers, getting into Wall Street.
Right.
And so all of these computers were actually taking over the work of people of deciding when to buy and sell. So it was running the market up, because when the market went up, it triggered a computer to buy more,
Right.
which triggered another computer to buy more.
Right.
And they're all buying. And when it started to go down, it would trigger them. They all had rules of when they would trigger to sell. That's what a flash crash comes much quicker, because computers can do it in seconds, what it might have taken hours for individuals to do.
Yeah,
we learned some lessons about that.
Right, right. It's very much a self-fulfilling prophecy, right? In that situation. So that was Black Monday, 1987.
Yeah.
Dave, why don't you do the next one?
Next one, 2000s hit, and that was the dot-com bubble.
Yep.
Right? So after the flash crash, we had almost 10, 11 years of up market. The 90s were the golden time to be in the stock market. It went up, 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 and it just like in 29, there were times, I remember this, when they're like, the market's, it's a new economy. They kept talking about the new normal.
Right.
Take away from this video, if you hear anyone ever talk about the new normal, run. Because every time they say that, you usually have some kind of a correction or a reversion to mean afterwards.
Right.
So in the 90s, people were talking about, because of computers and technology, it's a new normal. We're never going to go down again. The economy is going to continue to go up because of technology. Sound familiar? We're talking about AI today.
Right, right.
Well, what happened is the markets were going through the roof, especially the technology. The NASDAQ, which is the technology index, Chase, it increased by about 1,000 points from 1,000 to, it increased from 1,000 points to 5,000 points.
5x, right?
From 95 to 2000.
Oh, yeah.
Right? And people were just betting on this new technology. It might be hard when you're listening to this to conceive of this, but computers were so new, people just thought everything was going to change, and it did.
Right.
But everybody was jumping into computers. In fact, you had everyday companies that were doing nothing, had no relation to technology, that were changing their name and adding, get this, .com to their name. And then their stock would go through the roof because people would think it was technology.
Right.
Well, as you guess, it wouldn't take long, right? And then the markets did correct, right? Because many of these companies never made money, had no business plan. People were just throwing money in, just betting on the come, like a Ponzi scheme.
Right.
And in early 2000, the bubble began to burst. 5 of the NASDAQ's 15 worst days that they've ever had happened between April of 2000 and January 2001.
Yep.
Right. So it's really the worst case scenario for the NASDAQ. And the rest of the market kind of followed a little, but mainly it was the NASDAQ.
Right. Right.
Right? On April 14th of 2000, the index fell by about 10%, second biggest single day decline ever at that time. And by the time the market bottomed out in October of 2002, the NASDAQ had lost 80% of its value. Now the S&P and the Dow fell too, but nothing like that.
Right.
Right. So that was an index, that was an interesting crash because it was now more localized to one part of the stock market.
Right.
Even though the rest of the market fell, because ever heard that phrase? A high tide raises all ships.
Right.
It works the other way. Low tide lowers all ships. So
Right.
if one part of the sector crashes, people get nervous because the market, and this is a great takeaway, it in the end is driven by greed and fear, not by analytics. Right? People make their decisions by greed and fear, and when everything's tanking, people panic.
Right.
And the stalwart companies that weren't tied to technology were doing fine, but they went down temporarily a little bit, but they actually did okay over time.
Yeah, and I think that's a good takeaway, right, of this kind of conversation is every correction has its own kind of identity, right? There's no one knows the future. No one has a crystal ball as to what the next one will be the trigger or who will be affected by it. But I think the takeaway thus far is corrections do happen in the stock market. We don't know what will cause them. We don't know how they will play out, but we do know that they do happen, right? So and we'll kind of tie this in at the end of the video, but if you're in the market, right, expect that there will be corrections kind of along the way.
And I would say this one, where it differed from the other two, one of the lessons from this one is why you hear so many people in our industry talk about diversified portfolio.
That's a great point.
If you had thrown everything into the NASDAQ because it was a hot
point.
commodity, you'd have lost 80% of your life savings.
Right.
If you had diversified, it wouldn't have been nearly as bad if you were in real estate and Dow Jones and some of the ones that weren't, some of the stalwart stuff that didn't go down as much. Diversification is the lesson from the dot-com bubble. Okay, let's take a pause there, Chase. We'll pick this up in our next video, part 2.
Talk to you soon.